Okay, welcome everyone to Ask the Experts webinar today on post-merger integration. We have close to 100 participants on today's webinar and appreciate each of you joining. My name is Ryan Gamble and I'm a Senior Managing Director with Riveron and lead our national tax practice. This is our 9th installment in our Ask the Experts series. Our goal today is to provide an update on what we're seeing in the market in terms of M&A activity and highlight some of the challenges companies are currently facing with respect to post-merger integration and ways to successfully navigate those challenges. I'm joined today by 6 of my colleagues. Vipul Bahaya is a managing director in our transaction advisory practice and focuses on integrated diligence and works out of our Chicago office. Ann Heffington is a managing director in our Dallas office and leads our Fed tax practice. Megan Jukta is a senior manager in our tax practice in our Chicago office. Kirk Lane is a senior manager in our business process improvement practice and offices in Denver. Sasha Morozova is a managing director in our Atlanta office and focuses on her practice on carve-outs, mergers, acquisitions, and IPO readiness. And Greg Surich is a managing director in our technology enablement practice in our Dallas office. Before we jump into today's content, just a few key reminders. On our website, riveron.com, you can access all of our webinars and thought leadership on a variety of business topics. During today's webinar, we will ask 4 polling questions that must be answered to obtain CPE. Please make sure your pop-ups are enabled, as sometimes they can prevent the polling questions from appearing on the screen. We welcome your questions. There's a Q&A option in Zoom. We will try to address those questions during the course of the presentation. However, if we're unable to address some of the questions, we'll provide a list of the questions and our responses to everyone participating on the webinar. The webinar evaluation form and CPE certificate will be emailed to you within a couple of weeks, along with today's presentation. And with that, I'll turn it over to Kirk Lane to provide an update on what's transpiring around M&A activity in our post-COVID environment. Kirk?
Thanks, Ryan. So we want to kick off today's session with a quick review of several key areas where COVID's impact has been most acutely felt. Although market conditions have improved considerably since the beginning of the pandemic, deal activity has continued to lag as companies seek to preserve capital in the absence of a clear macro outlook. Regardless of financial conditions, many companies that would have been active deal participants are instead looking inward to focus on employee welfare, internal projects, and most importantly, securing business continuity. Additionally, valuation has become increasingly difficult to execute due to the extended timeframes of many transactions and the correspondingly higher potential for enterprise value flux. Additionally, although a lot of firms have adapted well to a remote environment, conducting transaction diligence at a distance is a challenge, both in terms of the logistics of executing that, as well as establishing that trust factor with the counterparty. And lastly, for most industries, forward-looking guidance really can't be taken as gospel at the moment, leading to difficulty in establishing confidence in those projections, as well as the time frame and valuation generated by that information. A couple other things to keep in mind. Obviously, sustained volatility in capital and commodity markets, as well as fiscal and monetary policy, have introduced further instability and noise to the long-term outlook for markets. And a shutdown of broad sectors of the economy for an extended period of time is an unprecedented experiment, if you can call it that, in really macroeconomics, and has uncertain ramifications, clouding attempts to forecast deal activity into Q4 and beyond. Private equity in particular has seen a number of trends either exacerbated or accelerated by COVID. Deal type, for example, has shifted more heavily in the direction of add-on transactions to existing portfolio companies. And although that pattern has been steadily increasing since the 2008 financial crisis, add-ons jumped 8% year over year from 2019 to 2020, indicating a desire to pursue targets that are more of a known quantity. Deal size, while steady for the past decade or so, has seen a dramatic drop. The percentage of PE investment exits with a total enterprise value greater than $500 million declined from 74% in 2019 to 51% 2020 year to date. And although a lot of factors are at play here, longer hold periods are becoming more common in an effort to avoid selling below market value. That said, despite these trends, dry powder is an incredibly high, overall $740 billion for the US private equity industry, suggesting that we could see a wave of transactions if conditions stabilize enough to shore up investor confidence. To drill in a little bit further on this, we want to look at an industry that Riveron does quite a bit of work in, which is energy. So after more than a decade of expansion, especially in unconventionals, M&A activity began slowing in the fall of last year, and investors are starting to see a mature industry which should be generating returns rather than pursuing growth. Consequently, capital providers have tightened the financial screws, especially lending to upstream E&P companies, whether that's for new operating capital, boosting output, strategic acquisitions, or the like. The collapse in the price environment to around $40 a barrel for WTI means that there's a lot more focus on restraining spending and maximizing profitability. And although conditions have evened out since WTI crossed into negative territory in April, it's still down more than 30% from the third quarter of last year. Most readily observable in two areas. Capital spending among the super majors, this is at a 13-year low, and per the IEA, last year's spending was around $89 billion, which is down 50% over 2018, and we expect that figure to slump even further in 2020. And rig counts, particularly U.S. onshore, they're down nearly 70% in the last 18 months. That being said, some of the most active transaction periods for the energy industry have come during significant upheaval. This includes the wave of mega deals around the millennium, despite 9/11 and the dot-com crash that created the super majors, and the price crash in 2014-15. And that latter market cycle is actually most similar to today's environment, where we're seeing opportunistic investors acquire cash-strapped assets for a relative bargain, particularly from smaller independents that are undercapitalized, over-leveraged, and really not built to be competitive $40 oil. And lastly, renewables continue to descend the price curve, particularly wind and solar, achieving price parity with oil and gas, and really presenting an opportunity for investors to pivot away from legacy energy and move to an industry that's a bit less dependent on volatile commodity pricing. So that brings us to our first polling question. When does your company foresee having sufficient clarity to re-engage in the active pursuit of transactions? Right now, end of the quarter, end of the year, or first half of 2021 at the earliest?
Kirk, while we're waiting on the responses to those questions, are there particular industries or sectors where you foresee activity picking up before the broader economy?
Yeah, great question, Ryan. Obviously, there are a handful of sectors, most notably tech, that either haven't seen a dip or have in fact prospered during COVID if you look at the latest batch of earnings releases. So they're the natural candidates to lead the charge. As far as activity turning around in a positive direction, tech-adjacent industries that are relatively insulated from stay-at-home mandates like insurance, telecom, media, they're starting to see some signs of life. And while we're unlikely to see that proverbial V-shaped recovery until some of the harder hit sectors come back, like aerospace, automotive, hospitality, we think that there are some sectors that provide some cause for optimism in the interim. Okay, so looking back, I think it's a fairly even split here, but the majority at least, or the plurality, looks like first half of 2021. And that's fairly consistent with what we've been seeing, right? I mean, there's just so much uncertainty, whether that's commodities, equities, regulatory environment, broader macro indicators. I think that's a fairly common response to, hey, we just don't have enough visibility or information to know whether active pursuits make sense right now. Okay, so moving forward to more of the tactical side of the webinar, I wanted to walk through some of the key factors that are really critical for approaching successful integration. This first section is going to focus on the pre-close planning process. So COVID or no COVID, there are many common challenges that integration efforts face. Some of these might be due to org structure. So for example, the first significant acquisition for a company that might not have the expertise to handle that internally. Personnel constraints. So this is the flip side of that problem, where you might have an experienced deal team, but they're fairly lean and they don't have the bandwidth to lead those efforts for more than a certain period of time. And shared services, most applicable to a carve-out situation from a larger corporate entity, but without the dedicated support of shared services organizations and the former parent, standing up things like FP&A, HR, IT systems can be a real roadblock. Additional challenges might stem from the expertise side of things. So incomplete, or what we would call non-holistic due diligence, which the poll we'll get to in a moment here, by which we mean DD exclusively focused on verifying earnings and legal analysis. And that can lead to a lack of visibility in the target's actual performance, potentially sidestepping operational, IT, HR liabilities that might undermine deal value. System scalability, so lacking the scalable IT systems and business systems for that combined organization can really deprive the entity of the automation and accurate data that's necessary for high-performing organizations. And cross-departmental collaboration. Particularly, this refers to the IMO and the Integration Management Office stand-up. Ensuring that you have representation across different functions is critical up front to make sure that those key stakeholders are bought in, and that you're ensuring effective end-to-end communication and execution to maintain that stable organization for implementation. Now I'll pass it off to Vipul to take us through the finer points of integrated diligence.
Thanks, Kirk. What we're seeing certainly is that an integrated due diligence approach positively impacts the realization of deal value, including potential synergies post-closing. And particularly in this environment, buyers, whether they're financial or strategic, want to evaluate opportunities using a more holistic approach to meet the challenges Kirk went through earlier. Bringing in the full complement of diligence services certainly helps to evaluate and or confirm the investment theses prior to close and identify all potential risks and opportunities to the extent possible. What this does is it mitigates potential post-closing erosion of value and provides more clarity and visibility on the investment required to further augment EBITDA and improve free cash flow post-closing. The integrated approach also widens the aperture to include insights into transaction structuring, strategic orientation, evaluation of synergistic opportunities, organizational design, management competence and gaps in key positions, as well as forecasts and budgets to fully validate or dispel the value proposition. We're also getting more involved with pre-closing support on SP&A advisory and language surrounding reps and warranties, as well as assist with post-closing negotiations and alignment. The value that we see that we just went through of integrated due diligence is further articulated here, with the major benefits being leveraging pre-close integrated diligence to a seamless transition post-closing and planning around opening balance sheet, purchase accounting, tax planning, structuring, and EBITDA enhancement, as well as accountability and alignment with one service provider. So, clients have one throat to choke from a process standpoint. Also, a streamlined approach on the diligence process, a more aligned approach on methodology and deliverables and insights helps facilitate pre-close negotiations and levers and inputs into purchase and sales agreements to further mitigate post-closing risks. A recent example of the benefits of integrated diligence, where Riveron started with financial due diligence to ensure there were no red flags that would impact the viability of the deal, but then expanded the scope to include comprehensive tax and IT due diligence to assist with identifying potential tax liabilities and to fully evaluate the quality and scalability of the IT infrastructure, including areas that could be improved during the hold period. Throughout the process, we learned that using the streamlined approach with both interviews and requests was really well received by the client and also eased the burden on the seller. The result was a successful completion of the transaction based on a thorough validation of the investment model, a streamlined approach with Riveron as a single service provider across all work streams, and a seamless transition into post-closing support. Brings us to our next polling question. What are the areas of your company's typical deal cycle which is most impacted by COVID-19? Is it A, target identification and evaluation, B, transaction closing, C, integration planning, or D, integration execution?
Thank you, Vipul. While we're waiting on those, I'm just interested to get your thoughts on what have you seen, how have you seen the diligence process change in practice, i.e. with active clients, during our current pandemic?
It's a good question, Ryan. I've kind of seen more of a shift, like I said earlier, in terms of widening the aperture on diligence to make it more holistic. So the integrated offering is certainly well received by our clients in terms of, evaluating an opportunity or an asset in its entirety, more in a kind of a more global approach, as opposed to the traditional siloed approach that we'd seen earlier. That's number one. The second one is certainly more of a focus on synergies, cost potential, post-closing cost saving initiatives, and identifying what those pro forma impacts to EBITDA would be prior to close. And then the third thing is focusing on the run rate pre-COVID, and then understanding what the run rate, whether that run rate would be fully developed and or received post-closing, certainly after COVID. So further analysis and evaluation of the forecast, not only necessarily going out 1 year, but a deeper dive into a 3 or 5 year forecast model. Well, it's not surprising here with the results that obviously target identification and evaluation is key to a deal cycle, and with this environment, it's not surprising that that's most impacted. And as we see the economy opening up, potentially Q4 early 2021, based on the responses for the earlier polling question, we're probably going to see a lot more deals flow in a market where investment bankers have been holding back, preparing their clients for an exit, but ensuring that the market is fully open.
All right, thanks, Vipul. So focusing now on the post-close execution, wanted to walk through best practices at a high level and then step-by-step through various functions. So similar to the integrated diligence approach that Vipul delineated, having a robust integration management approach is equally critical to success. Among other key activities, successful integration efforts in today's macro environment need to address a number of key areas, including but not limited to robust integration planning, the most critical elements of which are the creation of the day one readiness and 100-day plans, including communications and training and transition to the internal team. Consistent governance structure with defined roles, responsibilities, and ownership between the IMO and key stakeholders, as well as clarity on execution. Maintaining a fluid approach to due diligence, so working to rapidly identify both challenges and upside, but also building in ranges to account for likely fluctuations in value throughout the deal cycle. And lastly, staying agile throughout the integration effort. This means securing buy-in up front, striving when possible for consistency and timeliness in communications to the internal and external teams, and maintaining a strong focus on business continuity. To dig into this further, I'm going to pass it off to our team of subject matter experts, starting with Sasha, who will walk us through finance and accounting best practices.
Thanks, Kirk. Acquisition of the company results in significant time and resource constraints of the accounting and finance function. In addition to working on already hectic financial close cycle outside of the acquisition, finance and accounting has to think through a number of activities that have to happen during pre and post close of the acquisition. We generally group those activities into 3 categories: operational integration, technical accounting, and last but not least, getting auditors comfortable with the purchase accounting and opening balance sheet. Some of the main challenges from the operational integration standpoint includes ensuring that none of the key processes from the legacy company are lost and that they are either covered by the TSA or there is a day one plan in place to transition those processes. To help with the efficiency of the integration, some of the activities from the first and second bucket can be moved into pre-close or due diligence phase when target's detailed financial accounting information becomes available. Such activities include aligning accounting policies, close calendars, chart of accounts of both companies, as well as establishing combined company FP&A and internal reporting needs. Once the term of the purchase and sale agreement are solidified, some activities from the second bucket, technical accounting bucket, can be also moved up, such as preparation of white papers on various purchase accounting topics specific to the deal. For example, accounting for contingent consideration, treatment of stock-based comp changes, restructuring charges, and accounting for transaction costs. During the audit process, robust documentation on management judgments used in evaluation of assets acquired and liabilities assumed, including sensitivity analysis of changes in assumptions and their impact on the goodwill, will help reduce the number of questions from the auditors and will help expedite the audit. Auditors would challenge companies who just solely rely on a third-party valuation specialist to determine fair values without having significant involvement in development of the assumptions used in the valuation. Also, since there's a lot involved in getting acquisition through the audit, it would be important to have all parties, including management, auditors, and valuation firm, commit to a timeline to ensure that there is no audit delays. And with that, I will pass it over to Anne, who will cover integration consideration from the tax perspective.
Thank you, Sasha. Let's start with the typical challenges that the tax group feels when integrating with a new company. Access to historical data. I'm currently working on a deal where 10 days is all that the acquiring company is going to have access to the historical financial data. That is difficult in that if an audit comes up, you need years of data to support the positions taken. Another challenge is short year filings. So does the acquired company have a change in control that causes a short year filing? If so, the federal return is filed first, and then once that return is filed, the state return clock starts ticking. So you need to be aware of the impacts on your short year filings. Attribution limitation rules. With a change in control, you have limitations on your net operating losses and credit carryovers. One other thing that come to mind now in 2020 is the CARES Act. And if the acquired company has taken advantage of the payroll tax deferral or a PPP loan, whose responsibility are those payments later if the PPP loan has to be repaid? And when the payroll taxes have to be paid in 2021 and 2022, whose responsibility is that? So it's important to think about those things. Also, bandwidth of tax personnel. A lot of tax departments are lean, and especially in today's environment when cutting costs is top of mind, some personnel have been eliminated. So sometimes there's not enough bandwidth to cover the additional reporting required in an acquisition. For change management, again, talking about personnel, it's important to define the roles and responsibilities of everyone included. Internal controls. You might have had great controls that covered your processes, but now with another company and another set of financials coming in, another set of processes, review your internal controls to make sure your whole new business and processes are covered. And then identify your new sources of data that are going to be pulled in for your tax provision and tax compliance. For best practices, we've referred earlier in the webcast on a due diligence report, so use that. If there are tax risks that are brought out in the report, take action on those for those that haven't been addressed. Maybe it's a nexus study, maybe it's an indirect tax issue. Use that to your benefit. Create a tax calendar that incorporates all the new companies and the new filings, combined filings, short filings, to try to make sure nothing falls through the cracks. Again, tax talent. Look at what you have versus what you need. How are you going to meet the deadlines that are ahead? Do you need an outsourced function? What is it that you have and what you need? And then it's always important to be aligned with the financial accounting team. Understand who the new people are. What are the new reporting timelines? Are there new systems that are going to be pulling in data for your provision and your compliance? So getting aligned with the financial accounting team is very important. But overriding all of it is communication. Communication with financial accounting, communication within the tax team, trying to let people know what the processes are, who's going to be involved. It's very important to keep the communication open and flowing as much as possible. Now I'll turn it back to Kirk.
Thanks, Ann. So operations diligence is really focused on exactly what it sounds like, addressing operational realities and factors on the ground that quality of earnings report or a legal review might not catch. So this includes things like evaluation of potential cost reduction. This can take the form of SG&A. So for example, combining organizations, looking at combining systems for ERP, for business systems, CRM, payroll, and so forth. Looking at supply chain optimization, so sourcing spend, taking a look at the overlapping purchasing organizations, figuring out where that can be eliminated or consolidated and leverage economies of scale. Looking at efficiencies in manufacturing, so that could be both shop floor footprint as well as facilities in general. And looking at other external contracts, so 3PLs, logistics providers, any vendors that are really feeding into this process. Is there a way to integrate those and really leverage the combined organization? Risk assessment, and this can take a number of forms, but this is primarily looking at operational risk. So capability of the leadership team as well as key working level employees, looking at the effectiveness of the operating model, any continuous improvement programs they have in place, making sure that that both jives with the acquiring organization and that it's built to scale. Cultural fit, which Megan will get into a little bit more in the HR section, but obviously this is a key factor to ensure that the organizations mesh effectively. And then looking at operational liabilities and market growth. So are there any large issues in terms of their operating model that might be destructive to deal value? And what are the upsides on the flip side of that? Looking at potential for new channel partnerships, selling through different channels that might not otherwise have been available. So assessing both the liability and the opportunity. Synergy analysis, we already talked about economies of scale, but combining and rationalizing back office or shared services organizations is a big part of this. Looking end-to-end on the supply chain. So not just the purchasing apparatus at the company to be acquired, but also looking at all the resources that have an effect on that. So the vendors and their secondary vendors, looking at low-cost sourcing, assessing really everything end-to-end to see if there's any more efficiency that can be squeezed out of it. IT infrastructure, we already spoke about this a little bit, but looking at ERP systems, warehouse management, dispatching, transportation, all of that to ensure that it makes the most sense for the combined organization, or that it can be merged into the IT systems of the acquiring entity and done at a efficient cost. And then integration planning. This kind of goes without saying, but back to the point we made earlier on best practices in general, ensuring that the ops team is very closely linked to the integration management office, the steering committee up front, to ensure that the 100-day plan, day one readiness, that the design of the IMO, design of change management is inclusive of the functional leads from operations to ensure that those folks are bought in, that they're on board, and that they're going to be advocates for and champions for the process as it continues. So next, I'll pass it to Megan to discuss HR best practices.
Thank you, Kirk. The HR items to be addressed as part of a merger or acquisition have far-reaching implications because they impact the overall workforce. And they often play a significant role in whether or not the transaction is ultimately successful. Many of the activities that are listed on this slide can and should be started during the due diligence process, as Vipul touched on in the integrated diligence section, but the execution will carry over into post-close and integration. I'd just like to highlight a couple of the key activities in each of the three buckets here: people, process, and technology. On the people front, identification of the key personnel that will come over as part of the deal and the associated retention strategy is critical for a few reasons. Number one, these key folks can help ensure continuity of operations throughout the transaction lifecycle, and really the goal there is to minimize disruption to current state operations. And secondly, they can help champion the message around why the integration is important, and can help leadership carry out the vision and strategy for this transaction. Often a transaction such as this may bring a level of uncertainty to the workforce. Naturally, employees will question what a deal like this means to them. Are their jobs going to be secure? Will their pay or benefits be impacted? And so it's important to have deal champions to help allay these concerns, answer employee questions, so productivity is minimally impacted. Another key activity is defining the future state HCM processes and operating model. This will help give you a holistic view of your future state HR organization and any gaps that you may need to plug. Once your future state HCM processes have been defined, it's important to establish associated policies as these will need to be in place to govern the newly consolidated companies day one. Other critical pieces for HR are around defining the future state benefit compensation, and total rewards plans and programs. You'll want to start this activity during due diligence and perform analysis and assessment of current plans because you'll want to look at things like consolidation, as this could lead to cost savings. Once you design your plans and programs, this will also highlight impacts to your current workforce, so you can begin to tee up communications and set expectations with employees on changes that may be forthcoming. And then on the tech front, anybody who's been through a transformation can attest to the fact that standing up a new HCM system and processes is no small feat and takes a lot of planning, coordination, and time to execute. Often, though, the timing of these deals drive the timeline for migration from the old payroll and benefit platforms to the new platforms. And this will need to be balanced against the other priorities of the integration and just the overall employee experience. One final point I'd like to make on the tech front is the importance of factoring the future state HRIS landscape into your overall IT plan. This will help ensure that you have a holistic view of all of your systems and cost, and ensure you're putting together an integrated platform to support all back and front office operations. And just to echo a couple of the key points made by Ann and Kirk, some overarching themes that are critical success factors to the integration and to ultimately to the merger or acquisition is around culture, communication, and change management. As Ann mentioned, it's critical that the lines of communication are open, you're communicating early enough, and obviously balancing that against the level of transparency and confidentiality required as part of the deal. But employees, again, will be concerned about what this means to them, so communication is key. And also the cultural piece should not be diminished as part of this transaction. So making sure that you're joining the cultures and communicating what this future vision and organization will look like to get employees to buy in early. And with that, I'll turn it over to Greg to dive a little deeper into IT.
All right, thank you, Megan. It's safe to assume that every deal kind of has its own unique footprint, and that has to be understood as you go into each engagement. So, whether you're standing up a new company as a result of a buy or integrating a new company with an existing company, from our experience, it's extremely important to take into consideration the full spectrum or the ecosystem, if you will, of the technology landscape. From my perspective, the success of post-integration really starts in the pre-buy due diligence piece. You've heard that from my other colleagues in other sections. Ultimately capturing the full value of the deal is really relying on how well the integration is planned. Each technology organization within a company or companies tends to do things differently and prioritize tasks differently. From a Riveron perspective, though, I could say successful IT integration requires that all the functions are in alignment with the go-forward strategy. This starts by understanding and looking at common functions such as IT strategy and architecture and business applications and infrastructure, and of course, security, risk, and controls, which is paramount to most companies these days. Of course, that also means you have to have a good pulse on the financials and budget and expenditure, so we can't forget that, of course. So similar to my colleagues and other functions, we look at IT integration in 3 components: people, process, technology, all of which are supported by key activities. So on the people side, really starting off, it's important to understand the organization's key capabilities and structure, the IT organization's key capabilities and structures. When you begin that integration, you want to know the key critical skills needed, not only to support the integration, but also how to identify the future needs as well. Roles and responsibilities, very important as you start off, so everyone is clear across the IT organization, the part that they now play. Communication is absolutely key here. And it's part of a good change management plan, of course. So you want, like other organizations, you want to have key champions for sure within the IT organization to enable success. And lastly, you want to align the organizational structure to functionally be able to support the business from a technology standpoint. Going into, transitioning into the process side, knowing the maturity and how key development of key business applications supporting the business is really important. You want to know if you have inefficiencies, especially if you're bringing 2 companies together, if you have to combine processes so you can mitigate any potential impact to the business. Evaluating key IT governance, and key cross-functional processes such as things like, change management, being, the technical change management or asset management or problem management. Is another key factor. How do these processes align with some of the industry standards and frameworks that are out there, such as COBIT or ITIL? And then finally, security and risk are not to be overlooked. You know how important that is to a company and importance to a brand around IT controls. You want to ensure that you have good, solid controls and framework in place to ensure protection of data and physical assets. And as we kind of transition from process into technology, I would be remiss for not mentioning just a transition services agreement. Most of these engagements will have something like this. You want to make sure you have a strong TSA in place that really governs how you go from the seller side to the new company and how you support those services going forward, so that you have continuous operations until you get fully exited from the selling company. So last but not certainly least, as we talked about, is the technology aspects of the integration, looking at the key business applications and their applicability to the business. It's making sure that you have the right business applications, but also you want to make sure that you can look for synergies and duplication, especially if you're bringing 2 companies together. Additionally, you must look at any customization of software tools, right? Everybody kind of develops their own things because there are some unique things from each company. You want to gauge how that affects the kind of the go forward strategy and then plan accordingly. And last, like every company, it brings its own amount of technology infrastructure to a deal. Knowing and understanding the physical hardware and, including networks and servers, laptops, and facilities, right? Data centers, server rooms, cloud environments, all critical components for the continuity of technology operations. And many times, this is a primary area, as we've talked about in other slides, for improvement and cost reduction. So those things should not be overlooked. Kirk?
Thanks, Greg. So in addition to these best practices, we also wanted to share a handful of insights on adapting them to the current macro climate. Specifically, a couple of things. So adhering to what we call a selective deal funnel, which is really narrowing the target list to focus on things like healthy cash flow and businesses that are, if not immune, or resistant to a recessionary environment. What we call dynamic due diligence, so focusing on completing that process, as we spoke before, as rapidly as possible to minimize fluctuation, but accepting that a comfort range, quote unquote, might be necessary to address changing conditions and valuation. Robust integration planning, although we've said this numerous times throughout the presentation, robust integration planning remains critical, particularly regarding the development, rollout, and execution of the 100-day plan and all the communications and change management built upon that. And lastly, preparing to be agile throughout the deal cycle. Now, securing that buy-in up front to delineate roles and responsibilities is important, not only to reduce organizational strain, but also to enable that business continuity, because the rule here is to try to address the underlying business and ensure that disruption is minimized. So being agile, being flexible, given the shifting conditions around it, it's absolutely critical in today's environment. So given these best practices and adjustments for integration in the time of COVID, we'd like to also share some thoughts on the outlook for the deal environment going forward into Q4 and 2021. So clearly, a lot of question marks still remain, right? COVID's impact to the economy through first quarter of next year is a little bit fuzzy. But to exemplify that point, the week of April 17th was the first time since 2004 without the announcement of a deal valued at over $1 billion. Furthermore, there's been a 75% drop year over year in transactions of that size. So obviously the pipeline has been crimped a bit. That being said, there are a number of positive developments that we think bode fairly well for market momentum in 2021. Most notably, that despite the drop in deal size, 2/3 of the transactions valued at over $1 billion in 2020 occurred in June. So that indicates a positive trend that things are starting to reverse a bit. Additionally, the Fed's been a lot more active during this recession than at any other time in recent history, specifically respective to the 2008-2009 financial crisis. They've been very active injecting capital, injecting liquidity, stabilizing interest rates, and really providing that market stability that was absent the last time the economy went through a contraction quite this severe. Infrastructure funds are another interesting point of light. In particular, we think they could see an uptick in activity as a lot of the stimulus plans or secondary, tertiary stimulus packages have heavy infrastructure spending as a key component. Given the fact that these funds tend to have lower return thresholds and longer hold periods relative to more diversified funds, this could deepen the investor pool and increase valuation. And lastly, election anxiety over the 2020 presidential might drive some activity into Q4 or pull it in from 2021, as uncertainty on both capital gains as well as corporate tax rates and just overall friendliness to the business community could prompt certain counterparties to pursue and close transactions ahead of possible regulatory change and drive more activity than the environment otherwise might suggest. So that brings us to our third polling question. To what degree is regulatory uncertainty a consideration in your company's transaction process? Is it a primary driver, a major consideration, a minor footnote, or not a factor at all?
Kirk, thank you for that. While we're waiting on those, I have a question come through that's maybe best answered by you and or maybe Ann. In the event that a new administration takes over, and with the impending election, and reverses course on some of the tax policy that has been enacted during the current administration, what's the likelihood that those changes will impact or affect transactions in next year?
Yeah, really pertinent question. So last time we saw a significant tax reform was the Tax Cuts and Jobs Act in the first year of the Trump administration. That was signed into law in December of 17 and took effect in January of 18, a full year and change past the election. So obviously that was a net positive, cutting both rates for the business community and spurred deal activity. But I think the important factor here is the timing of it. So even if a new administration intends to raise either capital gains or corporate taxes or both, those changes probably won't be felt until 2022 at the earliest, perhaps even later if the GOP retains the Senate majority. That being said, Ann, as our resident tax expert, any further insight you'd like to share on that?
I think you did a great job, Kirk. I think that getting Congress to agree on anything is a challenge, and it will take a while. So I don't see an impact, Ryan, on the 2021 deals, but I would definitely anticipate the corporate rate will not stay at 21% much longer.
Absolutely. So unsurprisingly, regulatory environment is a major consideration for most deals, and I think that's completely appropriate, particularly given the activity that we've seen, questions we've had from clients, from folks in our networks about what does this really all mean. So I do think it's going to continue to be a major consideration even after some of these tax plans from both candidates become a bit more clear. I think there's going to be a lot of uncertainty and a lot more toes in the water in Q4 in terms of trying to pursue transactions that may not otherwise have been there. So next, Vipul is going to walk us through some of the details on the forecast for deal activity.
You know, what we're seeing in terms of kind of the key areas that we monitor as far as M&A activity is really, you know, any change in deal structures, what are our private equity clients doing, strategic acquirers, and obviously investment banks that drive our buy side and sell side, you know, transaction advisory activity. And what we're seeing is, you know, number one, with deal structures, we're seeing a lot more alternative deal structures to minimize, mitigate risks and uncertainties, whether it's structured equity, convertible debt, more minority investments, recaps. Certainly a heightened focus also on the language and purchase agreements in these times particularly, and more so surrounding reps and warranty insurance for COVID considerations. With strategic acquirers, we're seeing, you know, less competition due to the slowdown of the broader auction processes. But they are, you know, as Kirk mentioned earlier, a lot of dry powder in the market. They're sitting, strategic acquirers are sitting on strong liquidity positions and are really waiting for the market to open up, see the big potential, the big picture to actively pursue healthy assets. And they're eager to start seeing more deal flow again, you know, from the investment banks and, you know, key contacts in that, you know, particular space. PEs continue to assess and evaluate their portfolios, you know, getting ready to start, you know, actively pursuing large platforms. But in the interim, their focus is mainly to kind of continue pursuing synergistic add-ons, as mentioned earlier, and then waiting on the sidelines to actively pursue platforms, but only once there's more clarity on kind of the macroeconomic environment. With investment banks, certainly banks with more of a restructuring focus are doing better in this environment, and others are kind of working with their potential clients, i.e. sellers, to appropriately, you know, help them position the investment thesis so that when the economy opens up and M&A activity really picks up like it was pre-COVID, you know, their clients are going to be able to hit the ground running. So those are the kind of the broad areas that we're seeing within, you know, kind of the M&A industry. I'd like now turn it over to Sasha to talk about, you know, capital markets.
Thanks, Vipul. So as Vipul and Kirk noted earlier, despite challenges brought by the pandemic, the deal activity trend is starting to show a sign of improvement. And as a result, questions about various sources of financing become more relevant. In order to finance an acquisition of the company, there are several alternatives to equity and traditional debt financing. I'd like to bring up two of the most popular alternatives, which include private debt offerings, or so-called Rule 144A offerings, or asset-based lending. Private debt offering under SEC Rule 144A offers companies access to capital of sophisticated investors with limited filing and reporting requirements. The advantages of those offerings is that funds are raised immediately, as compared to an SEC-registered bond offering, which might take several months to complete, and reporting requirements are either deferred if the offering has registration rights or can remain private for life. As market conditions change rapidly, the ability to issue bond quickly via 144A is very beneficial for issuers, allowing them to act quickly and lock in favorable terms when markets shift in their favor. The drawback is that investor base is limited to qualified investment buyers, and they expect public company level information, so you would need to be prepared to provide a lot of extra information. There's also some cost involved due to preparation of the offering memorandum, attorney and investment banker fees, audit fees to issue a comfort letter, and completion of additional audit procedures and review of the document, inclusion of pro forma financial data. Asset-based lending has grown popularity as a source of capital and can be an attractive funding strategy for businesses with limited cash generation. There is obviously one big disadvantage of such financing is that the loan is not repaid, the assets are taken. There is also a risk that loan to collateral valuation will undervalue the underlying asset. On a positive side, ABL loans usually have lower interest rate as those loans are secured. Also, funding availability changes with the changes in the working capital. So if the company liquidity improves, it will also have great availability to credit. And with that, we have our last polling question. So in your experience, what has been the greatest challenges in post-close merge integration? We have 4 choices. A, system requirements. B, realizing projected synergies. C, culture alignment. And D, lack of integration resources.
Hey, thank you, Sasha. And we've had a question come through, Kirk, that I think I'll direct to you. In the event that integration resources are severely constrained, what recommendation does Riveron have to remediate the shortfall?
Yeah, very salient question, Ryan. So we see this quite a bit, actually, often due to the personnel constraints that we mentioned earlier. So namely that companies might have a deal team, but their time can't be spared for more than a couple of weeks, maybe a month. So in cases like these, Riveron can bring a larger advisory staff to the table, serving in a chief integration officer or integration management office manager overseer role, developing communications plans, guiding change management, overseeing execution. As I mentioned earlier, right, the golden rule of integration is to minimize impact to the underlying business. So we're happy to provide additional resources that will enable our clients to really focus on running day-to-day operations. Okay, so the poll results are in and fairly even split, but obviously the question we just addressed on integration resources is a main concern. Cultural alignment, I think, is another one. You know, Megan touched quite extensively on this, but it's not an easy thing to do, especially considering the fact that on most deals, the majority of the workforce is not clued in until later. And some of that might react negatively, particularly if it's a smaller business or a business that's been run the same way by the same people for a long time. So very much a concern and very much something that is a key focus for change management.
Hey, Kirk, while I still have you, we had another question come through, I think it's best suited for you as well. Of the market trends discussed in the Q4 outlook slide, have any been observed in practice?
Sure. So I think it's a mixed bag, Ryan. A few of these have been observed, at least in part, over the last 2 months, right? As we discussed, both deal size and volume are beginning to surge, and that we started to see that beginning middle of June. We've also been contacted by clients, whether for an active deal or for a proposed transaction, regarding accelerating their timelines ahead of the election. So there's kind of a building sense of urgency out there. Certainly the Fed continues to play an active role in providing the right conditions for M&A activity to recover. But generally, I think we feel confident in the direction things are moving, particularly if you look at some of the market thresholds. So, right, one of the key resistance levels for the S&P 500 is 3394, and checking just a moment ago, it's within 10 points of that, which represents the waypoint that we last touched in February prior to the proverbial COVID crash. So that's a pretty good sign that equity markets are close to breaking through that ceiling, which is generally conducive to deal flow, and we think continues that bullish trend that we've observed since late March and really since mid-June.
Great, thank you. I appreciate each of our presenters' time today, as well as everyone participating on the webinar. This brings us to the end of our presentation. And in closing, I just wanted to highlight a few additional resources that are available to you on our website. There you can find a number of additional resources related to COVID-19 and impact on business, in addition to a number of other topics. We really appreciate everyone joining today. Our next webinar is August 27th, related to current activity that we're seeing around lender services. And we look forward to connecting with you then. In the meantime, be safe and enjoy the rest of your day. Thank you.